Like a lot of things in crypto, staking can be a complicated idea, or a simple one depending on how many levels of understanding you want to unlock. For a lot of traders and investors, knowing that staking is a way of earning rewards for holding certain cryptocurrencies is the key takeaway. But even if you're just looking to earn some staking rewards, it's useful to understand at least a little bit about how and why it works the way it does. Crypto staking is a trend that has emerged in response to the growing energy demand resulting from proof-of-work protocols such as the one used by the Bitcoin blockchain to validate transactions. Basically, staking cryptocurrency involves acquiring and setting aside a certain number of tokens that will be used to validate the transactions made through the blockchain. This innovative protocol, known as proof-of-stake, is less energy-intensive as it eliminates, or at least reduces, the need for using a lot of mining equipment to keep the blockchain secure. Many blockchains, including Ethereum, have now adopted POS protocols to power their networks as a response to growing environmental concerns over the increased adoption of cryptocurrencies. By simply holding these coins, the buyer becomes an important piece in the network's security infrastructure and is compensated accordingly. Imagine you are still a kid at the dinner table. Most cases, no one eats until mom or dad finishes praying or gives the go-ahead, especially on special occasions like Thanksgiving. That's more or less what proof of stake is. The person with the most coins has the most authority and determines what kind of action should be taken. Staking income is offered in the form of interest paid to the holder, while rates vary from one network to the other depending on several factors including supply and demand dynamics. As the number of POS-based networks continues to grow, new alternatives to stake crypto have emerged including the launch of group staking, also known as staking pools, staking providers, and cold staking. These initiatives aim to democratize access to opportunities in the staking space to retail investors who hold a small number of tokens of a certain blockchain. How does staking work? The process of staking starts by buying a certain number of tokens in the network. It is important to note that staking can only be done in a network that supports a POS protocol. After the purchase is completed, the user now has to lock the holdings by following the procedure indicated by the developers of each particular network. In most cases, a staking transaction can be performed in a few minutes by following your wallet's instructions. On the other hand, cryptocurrency exchanges have facilitated the process of staking tokens by introducing features such as staking pools. These aim to increase the compensation obtained from staking the tokens of a certain network by upping the number of coins staked at a given point in time. So basically, a group of people can come together to combine their resources as a way of increasing their chances of being rewarded. That's a staking pool. In most cases, the higher the number of staked coins, the higher the number of transactions a given node will be assigned to validate. Nodes are ranked, in most cases, based on the number of tokens they hold. By the way, nodes are just a fancy way of describing a computer that connects to a cryptocurrency network. So, the higher coins or tokens your node aka computer have, the higher your compensation and authority. This is the reason why staking pools have become so popular these days. Now you might be wondering why don't all crypto run a proof of stake? This is where it starts to get a bit technical, so buckle up. Bitcoin, for instance, doesn't allow staking. To understand why you need a little bit of background. Cryptocurrencies are typically decentralized, meaning there is no central authority running the show. So how do all the computers in a decentralized network arrive at the correct answer without having it fed to them by a central authority like a bank or a credit card company? The answer is they use a consensus mechanism. Many cryptocurrencies including Bitcoin and Ethereum 1.0 use a consensus mechanism called proof of work. Through proof of work, the network throws a huge amount of processing power at solving problems like validating transactions between strangers on opposite sides of the planet and making sure nobody is trying to spend the same money twice. Part of the process involves miners all over the world competing to be the first to solve a cryptographic puzzle. The winner earns the right to add the latest block of verified transactions onto the blockchain and receives some crypto in return. For a relatively simple blockchain like Bitcoin's, which functions a lot like a bank's ledger, tracking incoming and outgoing transactions, proof of work is a scalable solution. But for something more complex like Ethereum, which has a huge variety of applications including the whole world of DeFi running on top of the blockchain, proof of work can cause bottlenecks when there's too much activity. As a result, transaction times can be longer and fees can be higher. This is sort of equivalent to being stuck in a 2-hour traffic. And to solve this challenge, proof of stake was born. A major way proof of stake reduces costs is by not requiring all those miners to churn through math problems, which is an energy-intensive process. Instead, transactions are validated by people who are literally invested in the blockchain via staking. Staking serves a similar function to mining, in that it's the process by which a network participant gets selected to add the latest batch of transactions to the blockchain and earn some crypto in exchange. The exact implementations vary from project to project, but in essence, users put their tokens on the line for a chance to add a new block onto the blockchain in exchange for a reward. Their staked tokens act as a guarantee of the legitimacy of any new transaction they add to the blockchain. If transactions in a new block are discovered to be invalid, users can have a certain amount of their stake burned by the network in what is known as a slashing event. But that's another topic for another class. Crypto staking has grown in popularity lately due to the attractive rewards crypto holders receive from this activity. At the moment of this video, interest rates offered by staking can go from 6% per year offered by well-reputed networks like Ethereum and Cardano to as much as 100% offered by smaller networks, for example, PancakeSwap and Kava. However, these high crypto staking returns don't come without risks, as multiple factors could affect the performance and security of your staked tokens. The first risk to mention is the possibility of a cybersecurity incident that could result in the loss of your tokens held within a certain exchange or online wallet. To eliminate this threat, some crypto investors have resorted to cold staking, an activity that involves storing your tokens on a piece of hardware like a hard drive. Cold storing your crypto assets protects your holding from a cyber attack, as the hardware will not be connected to the internet. However, the loss or damage of the hardware remains a risk when using this form of staking. So, it's a case of choosing your poison. Another risk of staking results from potential downturns in the price of the crypto asset during the staking period. Since staking works by locking your coins, you will be unable to liquidate your holdings in case the market goes sideways, and, therefore, you are exposed to the risk of losing a portion of your principal without being able to trim those losses by selling your coins. This is why the process of picking the best coins to stake should not entirely be focused on the rewards offered by the network. Other factors should be considered, including the lockup period and liquidity of the token. From the perspective of rewards, low-cap tokens tend to offer higher rewards than more established protocols like Ethereum to attract more demand. However, you may find it difficult to sell your earned tokens if the coin is very illiquid, meaning that daily trading volumes are low. On the other hand, large lockup periods can expose you to market risks, which means that you could lose a sizable portion of your principal by not being able to sell your coins during a downturn to trim your losses. Meanwhile, other tokens such as Algorand, Polygon, Kusama, and Solana offer even higher and, therefore, more attractive returns, and their trading volume is high enough to allow you to trade your rewards without hassles. The bottom line is crypto staking has become an attractive resource for investors seeking to earn income from holding cryptocurrencies, similar to how a bond or high-dividend stock would work. The attractive annual percentage rate, or APRs, offered by some tokens nowadays have attracted billions of dollars to this activity, and the POS protocol has also relieved some networks from the environmental concerns resulting from the energy-intensive nature of the traditional POW protocol. It's why investors flock to Cardano. However, like any other form of investing, crypto staking comes with risks, including the possibility of losing the coins held within your online wallet in case of a cybersecurity breach, or a loss in principal resulting from a sharp downturn in the price of the token during the lockup period. Therefore, you should analyze the risk-reward ratio of staking based on market conditions, the network's reliability, and the rewards offered by the blockchain for setting aside your coins to make sure you are being adequately compensated for the risks you are taking. We hope you enjoyed this video. If you don't want to miss updates and informative videos like this one, don't forget to subscribe to our channel and leave a thumbs up for the algorithm. Maybe you know someone who would be interested in the video and share it with him. Thanks for watching, see you next time.